This call is kind of the post Russia invasion. And listen, I've been talking about a number of things throughout the last couple years, and I've talked about the pandemic being a TSN turning point. If you're a sports fan, you know what I mean. And this time I'm referring to stock market history in terms of stock market history. And so if you've called in, I'm going to explain some of these slides, or I'll just read them to you. And if you've Zoomed called, you could follow along. So it starts with the 4 most expensive words in stock market language are "this time it's different." And that's a quote from John Templeton, who was definitely a mentor of mine, and met him personally, no longer of this planet, but he comes along with guys like Peter Lynch and Warren Buffett, and one of the greatest investors really of all time. And this time is different is very appropriate because you know, we are guided by stock market history, and when you get to certain inflection points and things that happen in the world, your best thing you can do is look at the playbook, because it's very rare that we haven't seen a similar event. And there was a question last call, which was an excellent question that came in and said, what happens if Russia does in fact invade Ukraine? And we said that based on history, whether it was the Iraq War and Vietnam, and you know, we can go on and on. But the reaction of the markets had not been swift or severe. There had tended to be some knowledge that this was going to happen beforehand. There's almost always a slight correction. And for the clients that called in and said, we should do something, we should liquidate, I'm going to try to change your mindset. So the clients who get worried about these major CBC News, CNN News, if you're that kind of person, if you could change your mindset to, I want to call and liquidate some of my account on these negative news, change your mindset to, I've got 50 grand or I've got 100 grand in my checking account, I'm going to send that in, because major negative news events tend to be good times to enter the market, not to exit the market. So if you had sold the day of the invasion, a couple days later, the markets had fallen just 2.8%. And now we're up about 5% from the time that Russia invaded Ukraine. And again, this is not a comment on, it's a terrible, terrible situation. People are losing their lives, children. But I'm just talking about from an investment standpoint, money has to go somewhere. So I'm going to talk about a lot of things we've talked about, but I might express it in a slightly different way. The headline today, and we talked about this even in 2020. We talked about this when inflation actually went into slight negative, and that was the money supply was expanding. And so based on our work for this time is different, we said based on history, when money supply expands at a rapid rate, you actually create inflation, not deflation. So despite the fact we were in the global pandemic, we began printing money and spending money and sending out checks. Now, this next picture is from 1974. It's one of those pins that was issued by Gerald Ford, who was the president of the United States in 1974. And the pin was "win." And we were going to whip inflation now. And the win button was there because inflation was becoming a real problem and it wasn't going away. And so win was, please companies, stop raising your prices and let's all just try to not partake in the inflation game. But I pointed out because the win buttons did nothing and inflation got worse, not better. So, you know, we're going to talk about this, but fortunately, our clients have been positioned in the places that we wanted to go to under a rising inflation environment. So this is a chart of the last year of the 5-year Government of Canada bond. And if you'll notice that a year ago, the 5-year bond was under 1%. And now the 5-year Government of Canada bond is 2.26%. The magnitude of this rise is quite shocking for most investors, and most investors are not positioned well. In fact, the 5-year bond in the throes of the pandemic got down to 0.4%, and the 10-year bond got down to 0.5%, which I talked about on my calls, may have been the worst investment I can imagine, surpassing the tech bubble in terms of dumb investments. So we're going to talk about what rising rates and rising inflation means to investors. Now, the first one is if you went out and bought 1 year ago a bond that was 5 or 10 years to maturity at less than 1%, and today rates are 2.25%, that 10-year bond, if you said, I would like to sell that today because now it's a 9-year bond. Well, 9-year yields are over 2%. So you're going to sell that bond at roughly 90, 91 cents on the dollar. And that's because the pricing of that bond is such that the yield to maturity from the new buyer has to be equivalent to what they could go out and buy a new bond for. So that bond, bonds get priced like stocks daily in the marketplace. So I've got a chart here of the TD bond fund. And you can see that it's been an absolute terrible investment. And yet, shocking as it is, it's the 3rd biggest mutual fund in this entire country. And it's Toronto Dominion Bank's largest fund. So the 2nd biggest bank in Canada have decided that this is where their clients ought to be invested. And that fund lost 5% of its value last year. And just this year, we're not even a quarter of the way through, it's at -8%. And it just shows you that even if you buy a conservative asset, if you buy it mispriced, you can lose a lot of money. So this is, ironically, the regulators, oh, it's a conservative investment. Well, we're in the game of not losing 8% for the year. So that, of course, our exposure to the bond market at this point is zero. Now, clients will know, clients of mine that have been around since the 80s or 90s know that we love bonds. I love to make a low risk return, but we were buying bonds at double-digit returns. So when with yields we're under 1, we're not attracted to them, and nor are we with yields at 2. The RBC Select Balance Fund is the largest fund in this country with $80 billion of assets. And RBC, it was a good investment, but let's remember, this is what my competitors' return looked like. This is a fund that made 8% last year and is at -5 this year. Houston, we have a problem. And the problem is that they have a formula for balance, and that is 60% stocks, 40% bonds. And I call this a zombie investment portfolio. And it is the single greatest reason that we left one of the major banks in 2016, and we came to Canaccord, because the banks are just worried about regulators, and they don't care really what return clients get. They just don't want to be sued or do something wrong. So if you have a 60-40 portfolio, you cannot sue the bank because you've done the rational thing. But at the end of the day, the returns are going to be terrible. And I've said this in the past, but the returns out of these balance fund to me look like a zero for not just, well, they're minus for the year, not just this year, but maybe for the next 5 years as we deal with this inflation. So again, the playbook right now is very, very different than it was. And these are investors that use hindsight trading, and hindsight trading is what did well in the past. Like, it's incredible that TD thought that bonds were a great place to be. Well, in 2020, the historical, as rates came down and down and down, bonds went up and up and up. So, people were attracted to these funds based on history. Very few clients would say, yes, David, could you buy me a 10-year bond at 1%? In fact, at the lowest, the 30-year bond hit 0.7%. And this is when Canadians decided to pour a record amount of money into bond funds. And it's not just the funds you see at the banks. Canadians poured a record amount into bond exchange traded funds. Not one client ever said, I'd like to buy 0.7% for 30 years. So what happened was they just looked at hindsight. They weren't actually said, oh, that makes sense. So obviously, the most direct relationship with interest rate is the bond market. But let's talk about something else that's a game changer, and that's the effect of rising interest rates on real estate. I had a recent conversation. I'm going to simplify it a little bit. But a client said, should I sell my building, because he was a medical practice, and back of the napkin, we'll just round it up, but it was producing about $100,000 of rental income. Should he sell the building? And I said, well, how much would that building fetch? And the cap rate on the building was 2.5%. The 2.5% meant that really what you're buying is a cash flow, a rental income. And this wasn't a risky rental because it was full of medical professionals and people, that there wasn't a great deal of risk in the whether they could pay rents in a recession or not. So the valuation really is based on the interest rates that are around, and it makes sense that a year ago, if 5 and 10-year bonds were below 1%, the 2.5% cap rate just seemed like a terrific investment, because hey, you're making more than you would in money in the bank. But let's point out that as rates go up, cap rates change. So if the prevailing interest rates, say, go to 5%, your cap rate, that building, that rental building, is probably worth closer to $2 million, not $4 million. So be careful, because rising interest rates have affected the bond market. The next shoe to drop could be some of these other derivatives of rising rates. I want to talk about residential real estate, and I've mentioned this in the past, and we've talked about 81 and 91, which is really the last time we saw any material raise in interest rates, and the results were not good for real estate investors. But in 2019, the real estate market, especially in the major centers like Toronto and Vancouver, the bubble sectors, real estate was very soft. In fact, prices were down about 10%. And in 2019, rates had gone up to about 3%. And that meant people were paying more to renew their mortgages. So let's just do the math. Let's say, I've talked about how much mortgage you're going to have to pay if rates go up. But let's talk about a brand new buyer. And a brand new buyer goes into the bank, and the bank says, okay, here's how much the husband and wife are making. Here's how much you will qualify for, because you can spend this amount of after-tax dollars on a mortgage. So let's say the bank determines that you can pay $5,000 a month. And I use $5,000 because that's kind of a higher end rental. And then it becomes, oh, I'd rather own than rent. So January of 2019, $5,000, the bank would say, we'll lend you $1.19 million in mortgages, $5,005. COVID hits, it's the best thing that ever happened to real estate. Why? Well, first of all, people didn't want to work in their small apartments downtown. They wanted to be in the suburbs. They wanted to be in a nice house. But interest rates fell in half. So a new buyer says, I really want to buy a house and I can afford $5,000 a month. The bank says you can borrow $1.45 million. I mentioned this in the call over a year ago. I said the game is going to change and the problem is going to start when COVID is over. And again, I don't think it's actually over, but we're done with it. Like having been to the US a few weeks ago, nobody cares. Nobody's wearing a mask. Like it just seems normal. We're moving on. And as we move on and rates have gone up, here's where we are today. National Bank, which is one of the, my old boss, one of the lower rates around is 3.54 today. Those have been going up almost weekly. And my prediction is that they'll go up again next week. But at 3.5%, the bank now says you can afford $1.12 million. I mean, you guys can watch this math. So where people are calling in, excuse the fact that I'm kind of running through the numbers. Look, mortgage rates are going higher. So in a year, if we're at 5%, and this is where the Bank of Canada has told us that that's where we're going. So now the bank says you can afford $940, and a lot of real estate pricing is what the buyers will pay. And if the house is, well, it's 1.5, well, I'm out. You can't buy into that. So I put a question mark there because that's maybe where we're going, and I put it 8.7, and this may sound like an outlier, but maybe it isn't. And I put 8.7 because since 1950, mortgage rates have averaged 3% above inflation. It's extremely rare that you can borrow below the inflation rate. First of all, the savings rate, the T-bill rate, the bond yields have typically been above inflation. And the borrowing rates are another chunk above that rate. So the latest consumer price index data that we have in Canada is a 5.7% inflation rate. And that's actually the January read and the February read. And the March read is going to be significantly higher because we've had a spike in energy. And so we're going to be well north of 6%. But bear with me for a second. 8.7 mortgage, which is kind of, you know, again, this time is different. 8.7 is where they ought to be today. And that would say that you can afford less than half. You could only afford 45% of the value of a house if your mortgage is $5,000. So again, rising rates changes the game for a lot of different asset classes. So let's talk about what matters to us. We know we don't like bonds. What do we like then? Well, let's talk about the stock market for a second. So this is a little bit complicated in the math, but when you have a stock market, you have, say, the S&P 500, you've got 500 stocks. In the TSX index, there's about 230 or around there of stocks in the index. And those indexes are weighted up as, if you're in the S&P 500, Apple is the biggest weighting. There's 500 stocks, but down at the bottom, there might be a couple of companies at 0.1%, and Apple's 5% or so of the index. And so if you take those same percentages and you look at how much their profit estimate is, we have about $225. So a stock market is made of a numerator and a denominator. So and in the stock market, the history is we call it the price earnings ratio. And if we look at the S&P 500, the index is about 4,500. And the earnings estimate for that S&P 500 is about 225. Hence, we're at a price earnings ratio of 20, which is historically higher than normal. So another way of looking at this, when we're talking about interest rates, I'm going to talk the flip because it makes a lot more sense. What is the cap rate? What is the earnings yield? So if we take the earnings of the market over the market, we say that the stock market has an earnings yield today of 5%. So when you look at that compared to real estate with a cap rate of 2.5, when you look at it against bonds, which have surged in yield, as we talk about 2.25, the stock market still looks cheap. Now, in my last few calls, I talked about, the valuation differences between the average stock. I want to talk about where our clients are positioned, because we don't buy stocks at extremely high valuations. We love dividends and we like lower valuation stocks. And if we take the S&P 500 and we just say, let's go 1/500th per stock. So instead of Apple being at 5%, Apple just 1/500th. And we look at the valuation of the market, the valuation drops to 16 times earnings. So an earnings yield of the stocks that we're buying is 6.25. Okay. So the stock market, we've talked about this in the past. Money has to go somewhere. And, when we're looking for homes, what do? Because bonds are still extremely unappealing. 5.7% inflation, US inflation at 7.5. Part of the reason that Canada's lagged, maybe the single biggest reason, is the lockdown in Quebec and Ontario, which happened in the new year. Those lockdowns are over. The economy's opening up. We're going to rapidly approach that US inflation rate. Europe, one of the questions, Mark, I'm sorry, I'm jumping on one of the questions here. What about Europe? It seems to be a mess. Look, the best thing that could happen in Europe is a little bit of inflation, a little bit of pricing power. The price earnings ratio in Europe is 14, which is a shockingly high 7.15 as an earnings yield. And Europe could well be the surprise as hopefully there's some resolution to this conflict. But look, we like Europe, so no, that question was, should we bail on Europe? And the answer is we should be actually shifting as we go through more towards Europe. I want to talk about, where rising rates, because one of the questions we had last one, the excellent one, isn't rising rates bad for preferred stocks? We've been transitioning away from, there are two types of preferreds. One are called fixed floating preferreds, and the other one is fixed. So you've got a 4.5% dividend forever. Under rising rates, again, we're not at 4.5, but if we keep going up, those are going to be under pressure, and they have been this year. We've been focusing in on the fixed floating rate preferreds. So let's go through just a few examples, because rising rates is fantastic news for our clients that own these preferred shares. And again, you may not know exactly, but we own a lot of preferred shares. I'm going to give you some examples. And if you don't own the BCECs, you may own another one. They're very, very similar in terms. And the reason we own several different ones is for liquidity. We just couldn't buy all our clients one stock. So the BCE Preferred Series E, it pays out the prime lending rate. Now, 2 years ago, right in the pandemic, everyone thought that rates would go negative, that what if prime goes to zero, the dividend of BCE would be zero. Well, they've just increased the dividend because it pays the prime lending rate, a rate that banks charge their best customers. So the dividend was 2.45. It's just been increased to 2.7. So today, if you bought BCE Preferred E at $20.13, the dividend is 67 cents, or 3.26% yield. I don't know, that particular one has 2 decimal places of accuracy. The rest of them are all 1, but that's okay. That's I had wrote these and typed them up, so good job. Now let's look at where the Bank of Canada tells us that rates are going to go. If we look at where the dividend is going to, I'm going to get a rise, almost double. The dividend's almost going to double from today's rates. Now I'm buying it at 20. The par value is 25. So all of these calculations are based on 25, and I'm going to buy this at 80 cents on the dollar. In 2022, the dividend jumps to $1.17 or 5.8. Well, that's way better than a bond yield. And by the way, if in a year rates have gone and Bank of Canada is above 2, and rates look like they're still going higher, I don't care. I still get dividend increases. Unbelievable. TransAlta preferred F. TransAlta, Alberta Utility, safe, 21.16. Again, par value 25. Dividend today is $1, 4.7. Not pretty attractive, better than GICs and bonds. But in June, they're going to set the dividend for the next 5 years. People aren't doing the math. It's amazing. 3.1% in June, and above the 5-year Canada. So the 5-year Canada is already 2.25. So the dividend goes from $1 to $1.33. Everyone thought the dividend would get cut because rates are low. Well, rates have been going higher. So now, if I buy this today and I just wait till June, my dividend jumps to $1.33, 6.3%, which is a hell of a lot better than I can get anywhere else. Fairfax J on the bottom. 2.9% is based on the face value. So 2.9% at $21.50, the dividend is 74 cents, 3.4%. Ho hum, ho hum. Well, wait a minute. These things float. They float 2.85 plus the T-bill rate. Well, the T-bill rates just a few months ago were 0.1. Now they're 0.55 on a 90-day, but April, what's the date of the next Bank of Canada? April 9th. Bank of Canada is going to raise rates again. In fact, looks like they could well go 0.5% instead of 1/4 per meeting. So based on where the Bank of Canada has told us that rates are going by next year, and this could be even going higher. Dividends $1.21, which is 5.6, and going higher. So fantastic news for us as investors, where we're going on our clients, and where we're going with our portfolios. In inflation, look, our clients are positioned because we saw this coming and we didn't think this time would be any different. So we still have room in the commodities trade. Printing money leads to higher commodities, and that's where we are. So Mark's going to talk on this on the questions, but we are, for the first time, and I don't mean a COVID recession, I mean an economic cycle. We are on recession watch. Now, please, this does not mean everybody call and say go to cash, because for now, cash may be the most unappealing asset class and the least chance of us surviving higher inflation. Higher inflation is not good. It's not good for society, but this is not a commentary on politics. This is a commentary on where we are going and how to direct our portfolios. So we are in recession watch, and that recession watch is for 2023. Again, this time is different. Recessions tend to happen 1 to 3 or 4 years after the first rate hike. In fact, this is a bit surprising, but since 1950, and I hope I'm not jinxing the world here, but the playbook is the playbook. Since 1950, after the first rate hike by the US Fed, which just happened this month, the stock market is up 1 year later every single time. Okay, and there's been many rate hikes. So it is too soon to bail, but we are on recession watch for 2023. So, that's kind of the playbook. Markets are down this year. We've said it's going to be a rough year if you're a market investor, and it's a really rough year if you are a zombie investor that, like many of our competitors are. Look, I've had 2 people recently come over from TD Bank, and it's absolutely mind-blowing to me that the largest position in these rather large portfolios was the TD bond fund. It's incredible to me that everyone thought that rates would go down from decimal 4, or they just are not very sophisticated investors. I'm going to jump the gun on one more. So again, follow the playbook. We got your back. Things are going to get different from the investment perspective. We've been warning about this and positioning for it. We're up this year. I think we're going to, I'll be consistent. I said this last year that it will be a difficult year for most investors, but we're going to scratch our way up to what I think is a decent year by being ahead. One question that we get, and I'm going to share this screen again. Mark's going to talk about the economic implications, but one of the questions I get is, what do I think about this NDP liberal alliance? And I'm not anti-liberal. In fact, I've actually said that I think Canada gets an A for how Bonnie Henry and Theresa Tam and Trudeau handled the COVID crisis. But a funny thing happened. We handed out free money, and it felt pretty good, and it went relatively well. And what worries me with a path towards an NDP, the Liberals, if they ran an election today, they may not win. So they're siding with the hard left, which is socialism. This is a headline that was today. Argentina hikes key rate to 44.5% to combat global supply shock. But we have a global supply shock in Canada and the United States. And the Bank of Canada is at 0.5%. The US Fed's at 0.25%. So Argentina, I went to about 10 years ago. It is the most socialist country that I've ever stepped foot in. And they hand out free money like we did. And if we don't stop the handing out free money, we're going to have inflation that goes higher and higher and higher. I was talking with my wife about, pharmacare and dental care by the government. And the problem is this is not spending on bridges and roads, which is one time. This is what's called an entitlement. And even when you get a new government, it is very, very difficult to stop printing money. And the only way you can pay for all of these entitlements is to continue to print money. And printing money is the root cause of inflation. Argentina was markedly poorer than Canada, despite the fact that they had entire towns built by the government. It's incredible. Built by the government for people that, were underprivileged. And so it seemed like a really, really good environment. But, Evita, Don't Cry for Me, Argentina was a terrible time. It was great, might have been a great story, but it was a terrible, terrible turning point in Argentina's history, of which they have not been able to fight inflation. And every time there's a crisis, they print more money and hand out more free checks. And by the way, they've increased rates to 44.5 because inflation has hit 52%. Again, it's not a prediction of where we are, but anyway, that's my thoughts on handing out free money. I am worried that we got to stop this because it does create inflation, and inflation is not the path to prosperity. It is the opposite of that. So I've said my piece, and again, everyone, thanks for hanging in. We will continue to look at the playbook. The playbook is rising rates, rising inflation. Money has to go somewhere. The war is, ironically, wars are stimulative for the economy for the rest of the world that isn't in war. But it compounds our inflation problem because Russia's the largest landmass, and if we're going to put restraints on oil, if we're going to put restraints on fertilizer and a lot of precious metals, it's going to mean that we pay more for things. And so stay tuned. I'm going to pass this over to Mark, who's got some thank you for excellent questions.
I'm going to start here because I think we got in excess of 10 questions that asked sort of the same thing around the yield curve and the current shape of the yield curve. And if you're a client of ours, yield curve has been near and dear to our hearts. And I think David and I have both said in our next life, we'd like to come back as the bond market, smartest person in finance. So let's talk about the yield curve, because as the Fed has gotten increasingly hawkish being more inclined to tighten credit conditions, raise interest rates, we've seen the shape of the curve move around a little bit. So just as a quick step back, the yield curve looks at, in the case of the US yield curve, looks at maturities from, say, 1 month all the way out to 30 years. And it provides a shape given where the yields fall from 1 month all the way out to 30 years. So in keeping on brand with our high-tech conference calls, I'll use this very fancy chart of my arm. When you have a normal sloping yield curve, it sort of slopes upwards, okay? Meaning that, 1 month yields are going to pay you less than for 30 years. And in that case, that's a healthy slope. Okay, it says that if I'm depositing money at the bank, I'm going to get a lower rate than if I deposit it for a longer term. And if you're the bank, you're going to be more inclined to lend then, because you're paying less on the deposits than what they can then lend out and make money off of. And that spread is worthwhile to them, and they're incentivized to lend. And that lending keeps the economy in expansion mode and grinding forward. So what we've seen lately with the Fed getting more hawkish, most central bankings getting more hawkish, is we've seen that curve sort of flatten out. And in some cases, we've actually seen it invert a little bit. And it's that inversion that's drawing all sorts of attention. But it's very important to look at where it's inverted. So as far as the yield curve inversions go, and David's written about these in a lot of past letters when it's happened, yield curve inversions have correctly preceded every recession we've had since 1955, with the exception of one small head fake in the 60s. But even that, got a slowdown right. So as far as predictive economics go, that's a pretty good scorecard. So it's worth noting. But for us, the most important spread or maturities to look at is sort of your 3 month out to 10 years. And that's because that's where the bank is taking in those deposits and they're lending it out long-term. And as long as it's profitable for them to do that, they're going to continue to do it. So what we're watching for, I know clients have asked about, 5 to 10s have inverted, 7 to 10s are inverted today. Yes, that's worth noting, but the more significant inversion level would be on 3 month out to 10 years. And even when that happens, it's not an immediate impact. There can be a lag between 6 months and 24 months before we see a recession and a real slowdown hit. So it's a really good question. It's worth noting, but let's pay attention to that sort of 3 month to 10 year part of the curve. Next question around the new initiative relating to Liberal and NDP surtax on profits on major financial institutions in excess of $1 billion. The question sort of says, well, what's the impact? So short answer is the impact is pretty modest. Details are light on exactly what it's going to look like. But if we were to take what we have in terms of details today, and we assume status quo for bank earnings, the impact on EPS for Canadian banks is sort of 1 to 2%. Royal would be the most impacted at almost up to 2%. And as far as insurance companies go, the impact's even less. As far as it, the details that we know right now, that tax only applies to revenue earned in Canadian jurisdictions. And so in terms of insurance companies, a lot of their earnings are more global. And so the impact to them, Manulife's and Sun Life's, is actually less than half of 1%. So I think the more important question about this is, banks are at a pretty good, or have just come off of a pretty good part of the economic cycle for them. And now governments are sort of going after them for more tax revenue. And you wonder, what does that do in terms of opening up for future more onerous or punitive taxation? So in terms of the current initiative, pretty modest impact on EPS for banks, and even less so for insurance companies. Next question. I've given a lot of thought about this. I know David has. Capital gains inclusion rate. Is it going up? And, beyond my kids keeping me up, this is next on the list of things that keeps me up at night, is what are they going to do with the inclusion rate? So short answer is, we don't know. I mean, unless you're in the room making the decisions, you don't know. If we go back, it's interesting. It was actually Trudeau version 1.0 that put in the capital gains inclusion rate, and it started at half of 1%, and it has moved around. There is precedent for it changing and it being a change as of the date. And there's also precedent for it being retroactive to the start of the year. So they can do either or. A couple of interesting things I've sort of paid attention to along the way, trying to figure out which way they're going to go. Last year, the Liberal delegates got together for a policy convention. It was done virtually, and they vote on different initiatives. Some get proposed, some are on existing policies. And one of the things they brought up was whether or not we should look at changing the capital gains inclusion rate. And it was actually voted against by 62%. So that's one interesting thing. The other would be an interview that Chrystia Freeland did. This was about a month ago. It was in the Globe and Mail. And she was asked, and I'll quote it, regarding capital gains tax, you're not going to change how it affects principal residents. How about the equity markets? And her answer was, no intention to go there. Now, wouldn't be the first politician to, change things up at the last minute. So there's no guarantees, but these are some interesting things we can look at. There's definitely smoke around this. As far as really wanting to tackle the deficit, capital gains tax and raising the inclusion rate isn't really going to do all that much. And there's definitely arguments to be made around, what's the elasticity around actual revenue collection if you do increase the rate. People don't have to sell. They can decide to hang on. You could see actual net revenue decrease if people just don't decide to sell or crystallize as many gains. So really good question. Don't have the exact answer. I'm as curious as everyone else is, but there's a few things we've been following that might give you a little bit of a leading indicator. Got a couple of others. Somebody asked about our comments on Canadian equities versus US equities. Hard for us to get into a lot of that on this type of forum. Compliance sort of politely asks us to stay as general as we can. But, as far as Canadian equities go, I mean, we've always said, and we've been clear on this for better part of it, going back to 2009 when equity exposure in accounts became more material, was that Canada is a very small market. It's very focused. It's banks, it's energy, it's materials. And without a proper tailwind, they're not going to do very well in the case of the commodity sectors. And we saw that for a long time. And we were pretty clear about changing that stance, as the money supply started to increase and we were concerned about inflation. So for the individual that asked this, give me a call. We can get more specific on your situation. And, there's been a couple other questions showing up in the chat around, if we gave you X amount of money, what would you do with it? Again, hard for us to dive into that too much today. There was another question on preferreds, and I think David talked about that. So I'll sort of end it there and turn it back over to Dave.
Thanks, Mark. That's it, everyone. As always, thanks for tuning in. Hopefully, you can go to YouTube. We'll get that out in shortly. Thanks you to Davina. thanks also to my traders. This has been a market that we've had to change our navigation. And Susanna, longtime veteran who's been with us. How long, Susanna? 15 years. She's got a brain. Her head is actually like this big, but it isn't. But she's got an unbelievable brain to be able to allocate. Alex just joined us, working really hard. Aaron Hoffman is the brains behind these preferreds, does all the work. And, you know, it is a lot of work. And by the way, if you know, talk about our competitors buy preferred ETFs, exchange traded funds. And we have done, my calculation, almost double the return than buying a zombie portfolio ETF. Not only do they charge 0.45% in fees, so if you're paying your guy 1%, that portion of your portfolio is now at 1.45. You know, the preferred index, again, we did double last year. It's down this year. There's so many opportunities, but if you're not doing your homework, and no one seems to be doing it, and say, hey, wait a minute, this one's going to reset higher. This is where the attractive is. There's tremendous value that we've been adding to our clients. So again, thank you, Aaron Hoffman. So any questions on that, you can fire him an email or a question, or Mark and I are here. And again, thank you, Fletcher. One of these days we'll have him on the call. Fletcher and Darcy running portfolios with us as well. Darcy Crow and Fletcher Hemmons. So thanks again, everyone, and see you next time.